Okay, all right. Welcome everybody. Bunch of folks trickling in. We're going to wait 1 or 2 more minutes and then dive straight in. But thank you for joining us, and excited to start shortly. Okay, all right. We'll get to it. So good afternoon, ladies and gentlemen. Very excited that you have decided to join us on our inaugural MLG Capital Connect session. My name is Brian Lieberman, COO here at MLG Blockchain Consulting. With me today is our Director of Research, Dave Miranich, who will be guiding us through an informative hour of discussion around digital assets. Briefly, to describe MLG before we dive in, we are a global venture creation and advisory firm with blockchain technology development and broker-dealer capabilities. We believe we have a unique look inside the crypto market as we touch on many aspects of the ecosystem and are primed to be delivering to you this session and hope that you will find your time spent here to be invaluable. We will be hosting these sessions on a monthly basis, and we will be discussing a range of topics. We are aware that there's a lot of interest in the space, and we believe prudent for folks to make well-informed decisions for when, how, and if they want to invest in digital assets. We want to educate and spread the word on how digital assets are a prudent diversification of portfolio and a potential hedge to traditional markets. Our goal is to build a relationship, and we can provide deeper dives on specific topics, and we'll also have in-person sessions like one we're having this weekend in Toronto, as well as in New York in the weeks to come. I'll be sharing some more information at the end of the call and with regards to those in-person sessions. As well, our team is also open to having one-on-one calls to dive deeper into some of the topics and see how we can help you all better learn about digital assets. So let's get to it. Dave, it's your show.
Awesome. Thanks, Brian. I can't see your faces, but looks like we have a pretty good turnout today. I'll also join in and say a big thank you to everyone who tuned in. This webinar is going to be the first part of a series specifically designed to get all of you smart on investing in digital assets. And we're all seriously excited by what we see going on in the industry every day. And so we're thrilled with the opportunity to finally be able to share it with you. So on a high level, at MLG, we fundamentally believe that blockchain is going to have a sizable impact on a variety of industries. While many businesses are still in the process of adoption and implementation, one place that we've seen significant change is in finance, fundraising, and capital markets. So if there are 2 points that we want you to all take away today, it's that first, digital assets are an entirely new asset class that are gaining a lot of traction and represent prudent investment decision-making. And second, digital assets are becoming effective vehicles to raise capital for companies. Investors are global, markets are open 24/7, and capital can be raised in weeks versus months. So today, we are going to take you through a detailed introduction to digital assets and explain why now they have finally become the technology that can take the transfer and exchange of money and value to the next level. We're then going to follow that up with an in-depth overview of the industry that encompasses digital asset markets, an analysis of the market itself and its performance, give you a look at institutional attention in new financial products like Bitcoin ETFs, spend some time on the topic of blockchain's impact on fundraising, and then finally conclude with some thoughts about how to appropriately manage your regulatory and portfolio risk. So let's get at it. But first, a little bit about me. For those of you that are unaware, my name's Dave, and I'm the Director of Research and a partner at MLG Blockchain. I've been in the space for a number of years now, having been involved with the FinTech Club and the Scotiabank Digital Banking Lab at the Ivy Business School as president, while also working heavily with the Blockchain Education Network and the Blockchain Research Institute. But enough of that for now. What I'm actually here to tell you today is that even though we just started this presentation, most of you should already be quite familiar with digital assets by now. The reality is that you've been interacting with them every day for likely more than a decade. Digital assets include everything from pictures, video, news media, and music. What the advent of the internet did that was so significant was mark the first time that digital assets or value could be shared peer-to-peer over the web. What happened though that was so threatening to established industry players is that through sharing, these assets, particularly music, were copied and replicated, effectively crippling their value on the market by removing their scarcity. This led to disruptive new business models like Napster, large regulatory involvement from the FCC, and the creation of digital copyright laws to attempt to protect the incumbents. You know, on the surface, this seems a little familiar, if you ask me. But because of all this, what happened to the media industry at large was that it was effectively uprooted by companies that utilized technology to master the distribution of these assets. The reality, though, is that while digital assets were absolutely transformative for these other mediums, currency and money never quite got along because, as most people hopefully know, money shouldn't be copied and shared. That's counterfeit. Because of this, many of the earliest forms of internet money or digital cash didn't survive. Yet, that didn't mean that money and value transfer couldn't benefit from the fungibility or how easily tradable digital assets are. Someone just had to figure out how this money couldn't be spent twice. So, enter Satoshi Nakamoto and his 2008 white paper titled Bitcoin, a peer-to-peer digital cash system. What was so groundbreaking about these ideas is that through a combination of cryptography and mathematics, he solved the double spend problem. Essentially, he ensured digital money or value traded over networks could maintain their worth. And that is the most important point to drive home. So, after the beginnings of Bitcoin in 2008, we see the emergence of blockchain technology, its underlying platform. Eventually, in 2013, a 19-year-old kid from Toronto named Vitalik Buterin figured out how to take Bitcoin, the currency, and use the blockchain to allow for application functionality and smart contracts to be built on top. He called this Ethereum, and it opened up a whole new world of blockchain applications. In response to this, other protocols like Ethereum came out of the woodwork like EOS and Icon to try and improve Ethereum's core tech for enterprise adoption. Around 2017, initial coin offerings, or the process of raising capital using the blockchain, exploded in popularity, enabling companies to have raised over $10 billion in the last 2 years from this method alone. Now, in 2018, with all of this buzz, what we are really starting to see is large interest from enterprises and institutions, which is something that we'll get more into in a bit. So, what is it that allows digital assets to act as a cryptographic and electronic form of currency? Essentially, cryptocurrency meets the three most basic tenets of money. On a high level, this is that it serves as a medium of exchange, a store of value, and is exchangeable with other assets. If you need an easier way of thinking about this on a digital level, think about email. Email enables information exchange between peers. Blockchain accomplishes this very same thing, but with value. Now, this value is not just limited to currency. Digital assets can be programmed to record anything of value. So, with the properties of fungibility and distribution in mind, digital assets have now become a home for financial securities. These securities derive value from an external tradable asset, like stocks, bonds, and preferred shares, but are subject to federal securities regulators and are now under the watchful eye of FINRA, the SEC, the Commodities Futures Trading Commission, and the Financial Crimes Enforcement Network. Because of this oversight, compliance, like investor checks and anti-money laundering, must now be built into the issuance of these assets and can only be traded on exchanges that are approved by these regulatory institutions. Now, equity tokens are pretty much a subset of security tokens. All the same rules and regulations still apply. However, they're actually probably more liberal than many people realize. Because compliantly built exchanges are still in their infancy, companies have yet to really issue their equity on the blockchain. Yet, one example of a company's shares that are currently trading is Robinhood, the fintech unicorn. What happened here is that Swarm, a security token issuance platform, went out and purchased this stock from disgruntled former employees. They tokenized it and had it begin trading on secondary markets. Surprisingly, this is entirely legal, but has been met with fierce response from Coinbase and Ripple, who Swarm has announced as its next targets. Going to be really interesting to see how this one plays out. The last point I want to make here is that the traditional financial exchanges you see in the bottom right, are all waking up to the value tokenization is going to bring for markets and are all actively looking to incorporate blockchain-based backends and begin trading security tokens. There are some pretty prominent names listed there. So those are definitely some interesting developments to look out for in the next couple of months. So moving on to asset-backed tokens. These assets are exactly as the name suggests, tokens representing ownership of some underlying asset. These assets primarily benefit from global markets and digital distribution. What's really cool though, and what we are currently seeing in a variety of ways, is that the application of these asset-backed tokens through different means. The crowdfunding platform Indiegogo, that you might all be familiar with, has produced a real estate-backed coin known as Aspen Coin. Companies like Kinesis, Canabium, Tiberius, and Power Ledger have all moved to tokenize commodities from gold and minerals, marijuana, oil, and energy. And yes, Burger King in Russia has released a coin that can be redeemed for a Whopper. The last thing here to make note of is that these assets are all still considered securities by the regulators. Well, except for Whopper coin. Stablecoins as a whole have become extremely popular as of late. The Winklevoss twins have come out with Gemini, while Coinbase and Goldman Sachs and their funded crypto company Circle have collaborated on a joint venture that produced the USD coin. These assets are essentially pegged to the value of a fiat currency, like USD, and benefit from digital distribution, instant clearing and settlement, and no cross-border fees. The caveat here, though, is that these companies now must hold reserves equal to the value of the circulating supply of this coin. This is why Tether, which is probably the most well-known of all of these projects, has been under fire as of late because they've seemingly avoided verifying reserves despite claims that they're open to audit. Now, utility tokens are probably what most people think about when it comes to cryptocurrency. Utility tokens provide users with access to an underlying platform where they are given some sort of benefit. Bitcoin, for example, allows users to transact globally for basically no fee without paying foreign exchange rates. I also don't have to wait 10 days for my money like some wire services, and I'm not having to validate a transaction through a financial intermediary. That last point might sound unimportant to many people who are used to our version of banking. But think about some governments who have abused their economic power by rolling printing presses and devaluing the currency that its citizens have worked incredibly hard to attain. Think about the value of a potentially $80 flat fee to Western Union to the family of someone sending money back home in a remittance. Think about the value of all those charges a small business has to pay to a credit card company for customers purchasing goods at their store. Getting rid of the middleman starts to make a lot of sense. Now, Since Nakamoto and his white paper developed around a decade ago, both blockchain technology and digital asset markets have developed quite significantly. According to Gartner, the value add of blockchain to businesses could grow to be around 176 billion by 2025 and 3.1 trillion by 2030. Pretty serious stuff. Now, despite this development and progress, using a tool like the Gartner Tech Hype Cycle, we can see that we are currently still fairly early here and going through a more relaxed period after all the excitement at the end of last year. In our mind, this represents a pretty ripe time to invest. Now, once again, because of these emerging markets, many countries are still coming around to developing adequate regulatory frameworks or applying existing ones properly. Similarly, we are seeing several new players in a growing industry like the one we currently find ourselves in. Crypto exchanges provide very important services like digital asset liquidity and have exploded out of the gate with some very profitable business models. Binance did something like 550 million in its first year of operation. Crypto hedge funds, meanwhile, while they might have slowed off their 84,000% returns they are experiencing at this time last year, are still playing a pretty crucial role in funding the next generation of startups for an emerging tech paradigm. Now, the financial services firms are also integral, acting as the bridge between increasingly informed investors, such as yourselves, and a host of companies looking for capital. As I was saying, blockchain adoption has experienced some pretty serious growth from some heavy-hitting firms. Now, because of this, institutional attention is also growing heavier by the day. Goldman is heavily invested in Circle, a cryptocurrency trading company, while Morgan Stanley has just hired a head of digital asset markets. The parent company of the New York Stock Exchange has just launched cryptocurrency data feed, while the CFA has also added crypto and blockchain topics. Yale, meanwhile, has seen a portion of their famed endowment fund put into a cryptocurrency hedge fund. JP Morgan has made their own blockchain, and Fidelity has launched their own digital asset division. The list goes on and on. Moving on, prominent investment firms like Grayscale have estimated that over 70% of its new investors are from financial institutions. So, what has this increasing attention meant for investment? Well, new institutions have emerged as well. On our left, the number of crypto hedge funds has spiked dramatically, in turn causing the total number of crypto assets under management on our right to rise in kind. Assets under management for cryptocurrency funds is currently estimated by Morgan Stanley to be about 7.1 billion and growing. Next, we can see that due to the relative early maturity of the industry, hedge funds and VC firms are dominating the landscape in comparison to private equity. Yet, this does not mean that all firms are jumping in head first. Some don't want to be first movers in the space. Some are concerned about the reputational risk of an evolving regulatory framework. And some are concerned about the small but growing numbers of digital asset custodians. These are firms who typically hold crypto safely and compliantly for investors. Switching gears a bit here, I want to bring your attention to the performance of digital asset markets and where we see some important things headed. As we stated earlier, movements in the markets over the past 12 months or so suggest that we are still quite early. However, a slowing speculative frenzy actually improves the opportunity for investors to get in at reasonable valuations. Now, I'll have to be completely honest, I find these charts pretty unfair. On the left, we have the top digital asset performers over the last 12 months. And on the right, we have the top performing equities over that same time span. While the significance of this difference has to be taken with a grain of salt, what this comparison does underscore is the value returned to investors who get in relatively early. Now, based on these last charts, you might be asking yourself about the influence of market speculation. And once again, to be completely honest, there was a strong relationship 12 months ago where the price of Bitcoin, featured on your left, and the buzz on the internet, which is demonstrated on your right, proved to have a high correlation. However, things may be changing. It's actually quite funny then when we examine the recent realized volatility of Bitcoin, illustrated on the right, and we see that it's approaching a new low. What does this mean? Well, this trend is due to three significant factors that indicate price stability. We have increasing digital adoption by the masses. We have rapidly growing institutional attention, which we just spoke about. And finally, through the presence of a growing set of derivative products, we have signs of market maturation. Derivatives are also commonly seen as price stabilizers, and this is something we'll get to in a second. Now, what we see on the next slide is that over the last month, and due to the factors on the last slide, Bitcoin's price has actually experienced less of a percentage change and less volatility than the Dow, the S&P 500, and the NASDAQ. Now, I think what has to be addressed here is yesterday's performance, where Bitcoin's price took a little bit of a dip because of the news of Bitcoin Cash's impending hard fork. While we are still seeing lower overall volatility as a whole, price reaction to news is still something we'll see moving forward. In our minds, this is similar to how public companies' prices are often affected by the release of earnings reports. But the truth is that we are actually seeing a number of signs that point to more stability and more efficient markets. And the reason for that is because of the coming of Bitcoin ETFs. The coming of a Bitcoin exchange-traded fund might be one of the most talked about developments in the industry as a whole. JP Morgan has come and said, a Bitcoin ETF is the holy grail for owners and investors. And the reasons are actually quite obvious. A Bitcoin ETF paves the way for institutions to get into the asset class because ETFs are cash settled and don't have to be traded through Bitcoin. As a result, investors don't have to deal with wallets and custodians for access. ETF markets are also quite highly regulated and mature, bringing an air of legitimacy to Bitcoin's trading. In addition to all these things, all ETFs are fully insured by law, protecting investors from counterparty risk on exchanges. These regulations also have pricing standards through set indices that should prevent any attempts at manipulation. The introduction of smart institutional money should also help curb speculation in the market, leading to greater efficiency. And finally, if gold ETFs are any indicator, many analysts believe that we could see over $1 billion in attention on the first day of trading. As you can see on this slide, there are quite a few attempts to get one of these products to market. Unfortunately, due to the relative dynamism of the industry as a whole, this is actually not quite representative, but the most recent list I could find. However, points to make note of are that groups like VanEck and SolidX are the leading horses in this race. So, Bitcoin's been around for years, but what has taken so long for the emergence of an ETF on the market if it's so critical? Well, the SEC and the CFTC have a multi-stage test to accept the trading of an ETF. This is that markets first have to be considerably established, significant, and regulated to provide a deterrent to price manipulation. In the regulator's view, the Bitcoin market did not meet this threshold in March 2017, and thus early attempts were denied. Nevertheless, we have the benefit of actually having been able to obtain slides from one of the SEC's most recent meetings on the subject with a Bitcoin ETF proposal backed by SolidX. Essentially, this group came out and said that the Bitcoin market has developed in 4 serious ways over the last year. The first is that we now have derivatives, futures, swaps, and options on reputable exchanges like the Chicago Mercantile Exchange. These factors are also stabilizing forces on price and represent market maturation. These exchanges also typically do about 200 million a day in trading volume for these futures. Once again, to drive the point home, derivatives are proven to act as price stabilizers on assets, demonstrating signs of market maturation. The second significant change is the use of an OTC index for pricing and net asset value. The result of these financial standards and regulated indices means that price manipulation cannot occur unless undertaken by the OTC trading desks themselves. This would be rather silly because they are also under a fair amount of regulatory scrutiny. Then, building on this last point, we have the development of derivatives and OTC trading that has led to a greater and higher increased attention from the Commodities Futures Trading Commission. This means greater regulatory oversight as a whole. The third material change that SolidX has proposed is the introduction of information sharing agreements between players like the Chicago Mercantile Exchange and CBOE, leading to increased market transparency, which is obviously a benefit for all involved. You can see on the right, we have a listing of current ISA agreements in place, and these are growing by the day. The last change is within the product itself, and this is actually a trend that we are starting to see a lot from regulators. As we can see on the right, in order to ensure that sophisticated investors are investing in these products, the ETF is structured as a 25 Bitcoin basket. So essentially, unless regular investors are going through a brokerage, they won't be able to access these products because of price. We'll also see similar trends to this later with security tokens. The last point on this topic that I want to make is that we're all still waiting on word from the SEC on whether they're going to approve these ETFs. But the anticipation is definitely high from the industry. So we're going to switch gears a little bit here and talk about raising capital in financial markets. Capital is the lifeblood of any business. It is absolutely essential in order to grow, finance an acquisition, pay employee salaries, develop product, and fund operations. Yet, despite this obvious need, capital seems to be becoming increasingly harder to find. Initial public offerings, or IPOs, are one of the most common ways to raise capital in capital markets, And this is also experiencing a sharp decline. Recent reports state that the number of IPOs has fallen by over 70% since the burst of the dot-com bubble in 2000. The reasons for this trend are numerous. Because of the development of legislation like the Sarbanes-Oxley Act in 2002, the process of undertaking a public offering and doing it compliantly has become incredibly lengthy, resource-intensive, and expensive. The IPO process for a typical company lasts anywhere between 6 and 9 months, if all goes according to plan. Firms must also pay underwriter fees as well as significant legal expenses. Reports from the Harvard Business School have said that this has had a large impact on smaller companies choosing to go public that might have the same capital resources as larger companies, might not, There is also a growing trend of firms opting to stay private for extended periods of time, particularly within the tech industry. Most tech companies are valued based on profit potential rather than profits actually realized. What's happening is many of these companies are finding there is a significant discrepancy between private and public valuations and are choosing to stay private longer to justify this higher valuation and then have this number validated by the public. Brewing trade wars and increased geopolitical risk are also giving some firms apprehension about market timing. In the first 9 months of 2018, there has already been an 18% decrease in the number of IPOs, in part due to these factors. Finally, many tech companies have grand visions for their technology, and this deters them from going public because they're worried public shareholders' desire to meet short-term earnings will undermine the company's long-term strategy. This was demonstrated by Snap Inc.'s IPO when they issued no voting power to common share buyers. This was such a contentious issue that the London Stock Exchange actually refused to list them for this reason. In this same vein, there is also a growing desire out of Silicon Valley for the creation of what's called the long-term stock exchange. This is where companies would list and not have to meet short-term targets to once again focus on this long-term vision. Now, one last thing to consider is the success of private capital. But in a way, private capital has also been a victim of its own success. Success has breeded larger and larger funds. In fact, there are currently more funds with over $1 billion to invest than ever. The consequences of this concentration of capital means that although ticket sizes may be larger, the number of deals actually being handed out to companies is on the decline. Using a concept called VC math, it simply does not make sense for larger funds to hand out smaller deals if they want to make a return. So, because of these factors, companies are increasingly looking for alternative ways to raise capital. Lately, we've seen growth in strategies like a reverse takeover, popularized by your favorite weed companies. This is where private corporations buy shell companies that are already listed and have ceased operations in order to speed up processes and reduce costs. Firms also avoid some financial reporting requirements for doing so. Equity crowdfunding has been made popular by companies like AngelList. Here, firms essentially raise capital through an online offering of private shares. Lastly, direct listing was a strategy employed by Spotify. By going public in this manner, they didn't hire underwriters for the deal and therefore did not pay any fees. They also didn't issue any new shares. They simply started trading on the New York Stock Exchange. It's estimated they saved around $63 million by undertaking this process. So the point that we want to underscore here is that companies are looking for alternative ways to raise capital. However, no fundraising method has garnered more attention recently than initial coin offerings. An ICO is a method of raising money where digital assets or tokens are issued on the blockchain and sold to the public in a crowd sale. Many companies are drawn to this fundraising mechanism due to the significant benefits of the process. Raises represent a fraction of the cost of going public. Funds can be raised without affecting a company's capital structure and avoid share dilution. A firm's credit rating is also unaffected by this process, and token issuers have no obligation to pay back the investor. Furthermore, while governance can be programmed into these tokens' features, many come with no voting rights for the holder. Something that Snap, I think, would obviously like to do. Now, companies can also raise money shockingly quickly. Using a network technology like blockchain, funds can be raised from a global investor pool. Many ICOs were also initially targeted towards retail investors who did not have to go through the same lengthy decision processes on investment that is characteristic of large institutionalized funds. As a result, startups like Brave, a blockchain-based web browser founded by former Mozilla Firefox CEO Brendan Eich, was able to raise $35 million in under 30 seconds. Bancor, a digital asset liquidity provider, raised $153 million in just under 3 hours. In the past 12 months alone, companies have raised more than $10 billion from these public crowd sales. On this slide, we can see both the size of some of the biggest ICOs as well as the industry vertical they operate in. Moving on, we can see that on the left, in 2017, ICOs started representing a significant portion of funds raised by fintech companies. We can also see on the right that while venture capital still handed out a higher number of deals to blockchain companies, ICOs were more effective at raising a higher value of capital. The reality, though, is that while we are still seeing a growing level of compliance in ICOs, many of these raises failed to provide adequate investor checks and anti-money laundering schemes. In addition to this, the SEC has come out and said that while some utility tokens like Bitcoin and Ether may be exempt under securities laws, many others meet the criteria for security and therefore must be treated as such. Therefore, there's been a big push in the industry as of late to capture the properties of digital assets and the benefits of an initial coin offering, but undertake this process in a compliant manner. As we mentioned earlier, security tokens can represent a variety of securities, such as company stock, preferred shares, bonds, and physical assets. The offering of these assets also requires strict regulatory compliance, which we'll touch on more in a bit. The only real caveat here is that the infrastructure to both issue and trade these assets is still very much being developed. Existing crypto exchanges are all applying for their alternative trading licenses and looking to build compliance into their platform, while existing financial exchanges are looking to develop blockchain-based backends that will enable them to trade and manage these assets. However, the benefits of STOs are many. Tokens can be programmed to record ownership of any kind, even fractional ownership. This is particularly appealing when some assets, like real estate, for example, have priced out many buyers. Investors on these projects are also global, and this significantly broadens the pool of capital available to investors. By using smart contracts for deal execution and network technologies to raise funds, deals can be closed quicker with less intermediaries, slowing the process. Furthermore, being subject to federal securities laws increases regulatory oversight and enables legitimate financial institutions to invest. What this means is that we see less price manipulation and the end of pump and dumps that were characteristic of some ICOs. Trading also occurs 24/7, which can provide access to global marketplaces and have positive effects on market efficiency. Smart contracts and the inclusion of automation in the process of capital raising significantly improves processes like clearing and settlements, which can take days with traditional financial exchanges. With programmable governance, companies no longer have to adhere to strict standards, and capital raising can now be conducted without giving up voting rights and board seats that could compromise the long-term strategy and vision of a company. Lastly, investors in private companies now have increased liquidity for their assets. Now, this is far from an exhaustive list, but this slide shows the breadth of companies all looking to currently try and race to build a compliant platform that can issue and trade security tokens. We have banks, startups, crypto exchanges, financial exchanges, and large tech companies all vying for dominance in this market. Now, this next slide demonstrates the reason for this push. What we have here is a comparison between the size of current bond markets versus capital and crypto markets. While the digital asset and crypto market may be small currently, there are many in the industry that feel like these other markets could benefit significantly from the properties of digital assets. Therefore, it stands to reason that even a small capture of market share represents $1 trillion market opportunity. And this is definitely something to look out for in the coming months. We just threw a lot of information at you, but essentially this slide is meant to recap and demonstrate how token offerings are truly transforming fundraising. Now, as potential investors armed with this new information, the question then becomes, how does one appropriately manage risk and ensure downside protection in these emerging markets? The first answer is to know where you stand with regulation. While the SEC has come out and stated that some utility tokens, like Bitcoin and Ether, do not meet the definition of a security, the reality is that many of these do not qualify for these exemptions. The reason is that regulators apply a 4-part litmus test to these digital assets to determine if they meet the standards of an investment contract. This is known as the Howey test. This test states that if money was invested and it was invested into an enterprise, and the investment came with a reasonable expectation of profits for the investor, and lastly, that this realization of value was due to successful operation of the business, then the standards have been met to determine that this asset is a financial security. Moving on. All capital raises and security token offerings must undertake a number of formal processes for compliance. The legal entity of the issuing company, so the company that is looking to raise, must be subject to a background check, along with their management, directors, and top shareholders, to determine that these people are who they say they are and that this business is legitimate and not a money laundering front. All investors who invest money in this business must also go through this process. Tokenized securities can also be sold to accredited investors who meet certain requirements. These capital requirements are meant to demonstrate that these investors are sophisticated and knowledgeable, similar to the Bitcoin ETF. My personal issue with this is that this prevents the sort of democratization of finance and participation in financial markets that ICO has afforded everyday people. But hopefully, as regulation develops, a happy medium can be found. Raises also use offering materials like private placement memorandums to disclose the details of the offering and associated risks for investors. In addition, these offerings can only be underwritten by registered broker-dealers that have licenses to sell securities. Finally, the exemption of these raises falls under what is known as the Jobs Act, legislation designed by the Obama administration to kickstart public markets after experiencing a slowdown that we previously talked about. These exemptions I just mentioned are listed here. On a high level, they're designed to apply to a variety of offering types and a variety of companies while protecting investors. Regulation A applies towards US and Canadian businesses issuing under 50 million in equity securities. They are also exempt from registry with the SEC. Regulation D outlines 2 rules, 506B and 506C, that state unlimited funds can be raised only to accredited investors. However, there are differences with the quantity of investors and on the advertising restrictions of the deal. Rule 144A outlines specific holding periods for these assets, while Regulation S enables procurement of investment from overseas and can be done in conjunction with Regulation D. Moving on, we can see that due to these emerging markets, regulation differs globally. China has outright banned initial coin offerings, while North American offerings fall under securities laws. Some European countries are also quite progressive: Switzerland, Malta. And as we can see on this next slide, this is significantly warming the business climate for crypto companies, specifically exchanges. Many exchanges are taking advantage of this regulation and moving their operations to countries that are more friendly. However, risk also needs to be mitigated from the perspective of an investor's portfolio as well. As we can see here, digital assets represent a prudent diversification strategy. Returns on digital assets have been shown to have little correlation to stock market returns or macroeconomic factors. Digital assets as a whole are shown to have a different set of drivers more specific to these markets, and more emerge every day. However, the point to be underscored is that digital assets are a hedge to traditional financial markets. Moving on, we can see little correlation between the price of Bitcoin and the S&P 500. There is also little correlation with other traded commodities like gold, silver, copper, palladium, and Brent crude oil. Bitcoin also sees little correlation with currency trading. And similar results with gold ETFs. The one caveat here is that as financial markets become more linked to crypto markets, we could see a stronger relationship in the future. Nevertheless, the point to be taken home here is that these assets represent effective hedging strategies. Now, the biggest hedge that you can really make is by investing with the pros. MLG Blockchain is a global venture creation and advisory firm with blockchain technology development and broker-dealer capabilities. To be completely honest, we at MLG Blockchain are completely immersed in this stuff every day. We constantly have our ears to the ground, listening for emerging trends. We also have global reach and work with some of the best in the business. We have a team that has vast experience both in blockchain and crypto and in traditional financial markets. We are also a completely compliant firm that ensures investors and issuing companies are protected. MLG Capital has a variety of core competencies and offerings to best serve our clients. And finally, we are looking to provide you, the investors, with the tools to successfully navigate the space and the key considerations that we are also on the lookout for daily. Our aim at MLG is to significantly speed up your understanding of digital assets and their markets and put you in a position to best succeed. This concludes our presentation. I want to take the time to thank you all again for taking the time out of your days to come and learn about this fascinating and rapidly growing industry. We are here to take all of your questions, comments, and concerns, and look forward to learning and growing with all of you. Thanks.
Awesome. Thanks, Dave. That was a pretty incredible hour. Thanks, everybody, for sticking with us throughout the entire session, and I hope you found it informative and engaging. I definitely thought it was. If you're in Toronto, we're going to be doing a full 2-day deep dive session this weekend. So please send me a message at brian@MLG Blockchain if you are interested in pursuing that. As well, if you are open or interested in any one-on-one conversations as well, you can find our emails all on the slide above. Any one of us will be happy to chat with you. Thanks a lot, and thanks for tuning in to our inaugural session. Hope it was great, and have a great day, everybody.